What's going on, y'all? It's still Ham Sandwich with iTrendz, bringing you a course on options positioning. Before we get started, I just want to make a little announcement. We are releasing our options trading journal. It's going to come out Thursday or Friday. It's going to be a great way for you to track your options positioning, how you're performing, and what those percentage gains are throughout the week and how you're doing, and highlight some of the key areas that you could be making mistakes so that way you can fix those up. But let's just jump right into it. This is going to go over options positioning. It's really going to focus on whether you should be shifting strikes, averaging down, what you should be looking at when you're going into different option contracts, and how you should just be looking at the overall options market so that way you can understand what you're trading, how you're trading it, and what you should be expecting. Let's jump right into it. First off, tonight, what we're going to answer is a couple of these conditions. So a lot of people ask, how long am I going to hold on to this contract? Meaning, is this going to be a day trade, a swing trade? Am I holding it for the whole week? If I'm doing it for the month, that's one of the first questions we're going to answer. We're also going to look at your account size and highlight how much of your account should be allotted per play. So that way, you know, you're not over trading or trading contracts that just aren't viable to your specific account size. And we're also going to look over how big of an expected move that you're looking for. And that way you can kind of guide your stop losses and your entries and have a realistic expectation on where these contracts are going to go. So first thing we got to answer is, how long are you staying in this contract? If the stock has an implied move that's supposed to happen within the next month, there's no reason you would take a contract that's super far out. That means buying more time on a contract when you see a move that's going to happen within the near term. It's better to play weeklies or play a contract that is going to handle that implied move instead of just buying excess time, because those contracts may not move as quickly or a higher percentage if you were to trade a weekly contract. You have to answer how long you're staying in that play. And that's one of the biggest things I try to ask people, or something that I focus on. Is this day trade, a swing trade, or is it going to be a long trade? And that's something that you got to really get down and understand that timing is very important. And it's also important to time that timing of your entry and your exits. That's something that we do here at iTrendz, is we do track those contracts and we watch the flow of the market, because timing is very important. And there's specific trades that you need to show patience. That way you can time your entries and your exits to be the most profitable and have the highest percentage of profit when trading those contracts. There's some other things that go into contracts that really affect how contracts will move and your profitability, which those three items are volatility, the Greeks, obviously, and there's something that'll also help you guys along the way. There are option calculators. There's a lot of free ones. We're going to go over them, and that'll help you estimate, you know, which contracts to pick, what's the cost, and how much time you're going to need going forward. These calculators are very easy to access, but also you need to understand the way an option contracts moves, so that way you can use these to your best advantage. So implied volatility, this is one of the easiest ways to find out if a contract is worth what it's selling for. Implied volatility is simply the amount that this contract is supposed to move. Like when you're going into a earnings report, you can see that the contracts are priced extremely high. They're priced so that way they can predict the amount of move that's expected. So if there's not an earnings play, you may see a contract that's cheaper, or if it is earnings week, the contracts are all the way pushed up that they may not be worth playing. Just if you take a look at a couple of contracts from last week, they were way overpriced, and that's the way that iTrendz, you know, saved a little bit of money, because the implied volatility was too high. Contracts were overpriced, and that was just one way that we can protect ourselves by buying a contract that realistically wasn't going to be as profitable as it should be. The higher the IV is, means the higher the cost is going to be. But simple enough for us, those IV averages can be found online, so you don't have to worry about the calculations, but it's something that you do need to take into consideration. Now, little quick options. 101, the Greeks, those obviously affect your contracts. The one we're going to focus on tonight is the beta, and I'll go over that a little later. But obviously, the beta allows the trader to know how a contract will be affected by time decay, meaning if you're holding this contract, you buy it at the beginning of the week, it's a weekly contract. As that time decay goes on, that beta is going to increase, and that's going to affect your contract. Also, the delta tells the trader how much a contract price will move based on a dollar, meaning that you'll see this contracts move left to right, and that's something you need to pay attention to. Now, like I said, those option calculators, there are a lot of free versions online. And so there's a couple here down the list. There's optionprofitcalculator.com. There's also Options Education. That has another one there for you. They aren't necessary, but if you need a little extra confirmation or you want to see how they'll exactly calculate out, these calculators are perfect for that. And Unusual Whales also has an added feature, which I'm going to go over next, which really helps you visualize what this contract could pay out over time. So as you can see in this figure out on the right-hand side, this is an Apple 152.5 contract. As you can see, this makes it really easy to show you if a contract were to be moving up, what it could be worth, or your max loss going towards the downside. That's just something on Unusual Whales that I found very interesting. It's free to you for you to use, and it's just going to help you calculate your percentage of profitability. Every trade has a point when averaging down doesn't make sense. Let's just say you're in a contract that has 2 days left. You're $5 away from the strike price, which it has a historical rate of change of only 75 cents a day. It wouldn't make sense to average down on a contract like that just because it's so long gone. Instead, you'd want to shift up contracts to capitalize on that short movement into those last 2 days instead of averaging down on a contract that's already too far gone. So stocks have a historical rate of change over time, which you have to identify in each trade, and we'll go over that a little farther out. So another thing that you want to take into consideration before getting into any option contract or stocks just in general are what are the economic conditions. So that, economic condition could be the upcoming Fed calendar. Everybody focused on the FOMC meeting, which is a major market mover. Jay Powell, is he going to speak? Is there PPI, CPI coming out, et cetera? Those are big Fed movements that are going to affect the contract, and those are going to mix up what those contracts are actually worth based on those big pivotal moments and those reports that are coming out. Also, other economic conditions, ongoing war. We all saw how that Ukraine war, when it popped off, how it really affected the market. We've already seen how just little skits and little tips of the China-Taiwan crisis is really, really impacting not only Taiwan semis, but just in general, the fear in the market. And that could really move a market just based off little news just like that. And with the Iran nuclear policy, every time they gain uranium or they gain new nuclear components, the market does take a notice and they do brace themselves and they get into more defensive stocks when events like this do come into fruition. Other economic conditions, interest rates, inflation, obviously that's a big one that we're going through right now, GDP, unemployment, and then also trade wars. So another important thing when you're thinking about your option positioning is account size and your risk tolerance. When selecting a contract on a small account, a trader must focus on the beta. Beta is going to tell you how the movement of that stock and the average rate of change. So if it's greater than 1, that means that stock's going to be more volatile. And that means that it may not be beneficial to a smaller account to take a riskier position or a higher beta stock just because you know that's going to move all around. Now you can mix in higher beta stocks with low beta stocks, but it's just something you have to watch because if you're in a smaller account and you're taking high risk trades or high beta trades, then you're really not setting yourself up to success or to create consistent gains. And that's something we focus here on iTrendz is that consistent gains. We're not looking for home runs. We're looking for base hits all day long that build up and take your portfolio to the next leg. Just a little example at the bottom. Walmart has a beta of 0.52. That means it's a low beta stock versus Tesla that has a 2.11, meaning that Tesla stock, that implied move for every dollar, that's 2.11 that's going to move volatility wise, which that's why you see Tesla contracts can be very lucrative, but they also could be detrimental to an account. So you want to also take it into account the beta on every contract or just stock in general. So that way you're mixing up what's going on in your account size, and it's also tailored to your risk tolerance. You always want to have a stop loss, but in this relevance, we're talking about beta stocks, beta options. When it comes to risk tolerance, you want to pay attention to that because I find that's a struggle with a lot of beginning traders is that they don't focus on that and they're wondering why their trades are going red. It's because 9 times out of 10, you're in riskier trades, high beta trades, and that's just, it can be lucrative if your support and resistance levels are right, but it can also tear an account apart. So going into that beta conversation, something that we traded today was these Tesla puts. And when focusing on an option contract, you also want to watch at the volume when it comes to those higher beta stocks, like we said, with Tesla being higher up there. Originally, we were in I originally took a 680 put and a 780 put towards the beginning of the day. Now, the reason I didn't average down because there was more volume on the 750 puts and the 800s. So instead of averaging down on that losing position or just a position that wasn't gaining the volume that I needed to see, instead I shifted up from the 680s to the 750s and also shifted from the 780s to the 800. So lots of volume going into those trades. And that's the reason I shifted over instead of continuing to average down on a losing trade. As you can see, that 680 put and the 700 put were minus 40% on the day. And Tesla was actually losing on the day. It fell $12. So puts should have paid. But as you can see, if you're on the wrong strike or you're on a strike that's not liquid enough when it comes to those high moving stocks, they just get obliterated. The 680 puts started the day up over $1 and, they never came back. So if you're averaging down on that losing side, even if you have that time on that contract, you would have been more lucrative moving up. And in turn, since we did move up to the 750s and the 800s, instead of averaging down on a losing position and gaining a minimal amount, we gained 38% on our 750 puts, and we took 23% on our 800 puts. So as you can see, it's not always, you always have to focus on the volume when it comes to a higher beta stock and minding your support and resistance levels and just being comfortable with shifting a strike if you're not in the right contract. Next position I want to go into is CHWY. And this example is going to talk specifically about shifting strike for positioning. CHWY is a low beta stock, has a beta of 0.33, meaning that it's not going to move a great amount during the day, or those contracts aren't going to get extremely affected, meaning that you want to stay close to the money when it comes to trading a stock like CHWY. It's almost like a bank stock. If you're not close to that 50-cent line, then you're really going to get blown out. And the farther it goes out, if it were to go out, past that your strike or go raising in a put position, then you're really going to lose out. So for CHWY, what we did here, we originally entered a 41.5 put and originally opened those contracts at $1.67. We did have to average down 2 times just to get out of those contracts. But the reason we did that is because we know that CHWY is a low beta stock. It was drifting towards that higher side of 42. So we ended up shifting strikes, getting into the 42 puts because we wanted to better position ourselves going into the next day. Now, something you always want to take a look at is the monthly expirations going 2 strikes out. So as you can see, we're looking at the 916. That's the strike below. You can see that there's only a 40 and a 45. This is telling me that I want to stay close to the money when it becomes too CHWY, because the distance between those other strikes going farther out is up to $5, meaning those contracts in the middle, if they're not towards closer to the 40 or 45 during the week, or you're not right in the money, then you'll just get destroyed. So this is just an example of us shifting strike for positionings with CHWY being a lower beta stock. And we currently are in those 42 puts, and we're setting ourselves up for a great play going into tomorrow. Now, the last thing you want to look at when going into any options positioning is always identifying your support and resistance levels, staying close to your rules. And this is actually an example of how I did not do that. So initially we saw Disney, the day moved sideways pretty much all throughout the day. Disney was looking weak, and I actually entered into this put position at $1.71. And you can see that on my screen right here, entering at $1.71. Now, normally we have a rule here at iTrendz with the 9 and 21 EMA. We mostly want them to finish under or have a strict support and resistance level. And obviously, as you can see here, it was in the middle of nowhere. It was touching that 201, had a break of that EMA, and I went for it. Now, if I would have shown patience in this, I could have averaged down, which I ended up having to do after identifying my double top coming from back. And you can see this top in pre-market. That was a key level. So instead of rushing my trade, I took an average down when we got back up to this resistance level, and then it broke. It followed the 9 and 21, and we ended up taking 42% profit just by identifying our resistance level, identifying our support, and then playing it like that. So when it comes to option contracts, even if you feel like you're in the right contract, you feel like the stock is going to trend lower, you see weakness in the overall trend or in the market, this is one of those areas where patience pays better, because as you can see, entry and exit on Disney, you could have saved You could have saved money, and on top of it, you would have put yourself in a better position. And imagine if you could only open one contract, then you wouldn't secure as big of a profit, and you would have to fight all this downside. So definitely, before picking an option contract, or we're talking just positioning, make sure that you have your levels set and you follow your rules. And if you do make a mistake, re-identify your levels and focus on where the stock's going to go from there. Not necessarily you're in the trade, you're going to hold through and you're just going to say a prayer. You definitely always want to be updating your trades. You want to be updating your levels and stay current and stay up to date with your trade. As you can see, it took 42%. Disney closed out at 206 a contract. We're currently up 35% on that position, just based off averaging down and really positioning ourselves in an area for success. Now, like I said before, with that high beta stocks versus that low beta stocks, as you can see, this is a list of contracts that we took in our group today. And there's something I wanted to go over. As you can see, we have 2 Tesla trades here at 211, 252 beta. You can see that these contracts, very liquid. They had a very wide range as well, down to 310 all the way up to $4.75. You can see the Tesla 800 puts from 1350 all the way up to 1765. If you were in a smaller account, just taking one of these, if you see this range, you can seriously get blown out really quick. Another example of a high risk, high beta stock is a position that moves extreme over the amount of time. FaZe Clan opened up on the day at $9.58. It topped out at $15 and came back down. This one contract alone moved 253%. Getting a contract like that, even though the beta is not established, after a stock makes a move like that, that's something you want to pay attention to. Because if you're chasing a rally or you're late, this is something that can get really big, blown up, and it's very high risk. Last but not least, we have Boeing here at the end. Me personally, definitely a high beta stock at 1.37. So it's over 1, meaning that's higher risk. And if you have ever traded Boeing as an option contract, you can tell that that flow, that swing is very wide. So you're going to want to change your strategy or your average downs in that kind of stock, because you know that it's a higher beta stock. The swings are going to be more violent. So this is something you want to take into consideration. Now, if you're on that lower or small account, you want to mix in these lower risk trades. As you can see, we have Coke, Logitech, Bristol Myers, and we also have CCJ. Now, as you can see, these beta numbers at the bottom, we have 56, 78, 44, and 87. Here at iTrendz, we do try to mix in these lower risk trades just because they do pay off. Now, it is going to take a longer time, or you may not see a large percentage gains, but these are considered safer trades when it comes to trading an option contract. Like trading a Coke contract, they're sitting, average price sitting at 78 cents. I know on that Coke contract with the 56 beta, the lowest that contract's going to go, unless Coke takes an extreme runner, it's going to be around 60 cents, 62 cents. So now in my head, that's a lower risk if it comes to me having to average down a position compared to being a Tesla. If you get in at $17 and it's all the way down to 13, well, there's $400 compared to $18. It's just something you want to mix in so that way you can have those slow, steady hits, those slow, steady singles that are going to add up on your account. You can tell we took Logitech, another low beta, easy 26% right out of the jump. It's just something that you want to focus rotating these into your plays and to your account so that way you have steady gains. Bristol Myers is a great one at 44 or 0.44, and then CCJ as well. So overall, let's apply what we learned today. Key rule number 1, identify the beta. As you can see, you can go to Yahoo Finance. They have it written out there for you. It is a 5-year beta, so it gives you a good average there. But that's first what you want to do. You want to average in, 3 to 1, 3 low beta trades for every 1 high beta trade. So that way you're averaging your risk. Not only if, the contract goes wrong, but you're also averaging in that beta to where you have set steady plays and you have the one that can be volatile. All these contracts overall can be volatile, but if you're doing that, it's just one way you can help sustain your risk tolerance and sustain your account to where you have a higher percentage of success. 2, you understand your account size, and your risk tolerance. That's something you have to identify in the beginning. You obviously want to follow our iTrendz rules when it comes to applying how much you should put into a trade, how much you should set your stop loss out, because it's extremely hard to earn your money back after you do take a large stop loss. So that's something you want to identify right out the jump. So that way you can allocate your funds into as many contracts as your account will allow you to trade. And you'll also understand how much you can put into each individual options position. Number 3, you have to identify what type of option play you're playing. So volume, we talked about Tesla. You know, you have to stay with that volume. You have to go where the liquidity is, and you can't be afraid to move up a strike because that's where the volume is going to play. Because a high beta stock like that, you want to stay with the volume. When it comes to entry or exits, that's when we talked about Disney, where we're saying patience would have paid off in that scenario. So you want to definitely make sure that you have your support and resistance levels set, and you want to wait for that prime time to enter that trade. A big rule that people don't understand or have a hard time understanding is you don't have to trade every day. As traders, we have the ability to wait till the market plays our hand. So just because you're here every day, you want to be able to master your craft. So you want to be simulating contracts. You want to be paper trading. You want to be plotting those support and resistance levels. Just understand, you don't have to trade every day, and you can wait until the conditions improve, and that way you have those best entry and exits. But always be practicing, always be charting, because that's just going to make you better and better, and it's going to get your ability to identify these levels and really optimize on these option contracts. It's going to make you better as a trader. And obviously, we talked about that low beta. So that was that last page where you saw those lower strikes, or excuse me, that low beta is where we talked about CHWY, where it was strike sensitive, being on that 42 put closer to the money with that 33 beta. You understand that being closer to that money is a higher probability. And you knew that if that contract were to go the other way, those contracts are going to get least affected. And that's why you want to stay in the money. So number 4, you want to identify your exit, meaning that based off the trade, you want to see what a couple strikes are up higher in whichever direction you're going. So in puts, you want to go 2 strikes in that money to identify what that contract price is, because 9 times out of 10, that's where the contract's going to drift up to. So you want to have those levels set, and you also want to understand where your trim levels are. So if you trim every 25%, you want to have those levels already charted out on your chart or written down, so that way you know when that stock's approaching that, you put your stop loss in, or you take profit in, and it automatically hits. That'll save you as a trader, and that'll also help you prevent sitting there and going, oh wow, I have a hard time, collecting profit, or I sit there and I have a green trade and I hold it all day long and then it ends red and then I'm even more red. That's just one of the ways you can prevent that issue, and it makes you more successful as a trader. Last but not least, is something I want to go over at the end, is following long dated flow for confirmation. What that means is that if you're trading a weekly contract, you always want to go to the monthly expiration, 1 out or even 2 out, and see where the large institutions are loading up and which strikes they're hammering on as far as volume. Meaning that if you see a stock, we'll just take CHWY in mind. Like we said, we saw 40 and 45 out in September, both loaded. So that means that stock has to get one way or the other, because there's large institutions pulling it in that direction. So it's just something you want to look at, so that way it puts you in a better position when choosing those contracts. So I hope we got a little understanding when it comes to option positioning. This is Spence with iTrendz. If you did, go ahead and like this class, hit that like button. If you liked it just a little more, hit that subscribe. If you want to live trade with us, check down in the description. We're going to have a link to our Discord. Come join the community. We're live trading every day. We have our market watches on Sunday and Wednesday, where we identify these contracts. We identify these levels. We go over any trade that's in the community that you want to go over. So if you want another level of confirmation, past just watching our videos or learning, we're there for you. So go ahead, check out that Discord link. Like I said in the beginning of the video, look for Thursday, Friday, towards the end of the week, the option trading journal. Have that as one of your tools, something that you use when trading contracts. This has been the Stale Ham Sandwich with iTrendz, and roll tide.